Hey guys, welcome back to the Built Podcast, where we talk about everything real estate, business, health, and wealth with your hosts, Cody Journell and Christy Bowman here. And we have a very special guest today, Chris Lemons with Creative Financing Solutions. We're super excited to have you here, man.
I'm so pumped to be here. You have no idea.
Awesome. We've been trying to plan this for a long time. So We've done a lot of work with Chris in the past, him and his company, and we're going to talk about a lot of creative ways to invest in real estate today and get Chris's background and talk to you guys about, everything you can do, fix and flips, burst strategies, things along those lines. Mm-hmm. So without further ado, Chris, how'd you get here? Where'd you come from?
Awesome. I've been in the business more or less for 24 years in all realms of the space, from commercial real estate to the conventional mortgage world, FDIC background, all the stuff that shouldn't bring you to this path.
Sure.
I've been a part of. Very structured, very regimented, very regulated. And now I'm here. I run Creative Financing Solutions.
Awesome.
Yeah.
Yeah. I feel the same way in what we're doing in real estate now. It's like, got a little bit more freedom, flexibility. Mm-hmm. It's more fun.
Yeah.
For sure.
When the space is more fun, I think.
Yeah.
Both of you come from a normal real estate background. Mm-hmm. And don't get me wrong, there's that joy in someone explaining, man, this is the place I want to see my family raised and all that. And that's great. Love all of that. But I'd rather have these kind of conversations where it's like, I want to do the best for me and mine. Mm-hmm. I want to grow my personal wealth. I want to grow my portfolio and find strategies that make sense for everyone. I like that portion.
Absolutely.
Personally, leverage is my favorite word. So I'm interested to hear how you can help other real estate investors learn how to leverage your resources. Mm-hmm. So tell us about Creative Financing Solutions, how it started, and what your role is in the company.
Sure. So Creative Financing Solutions started as a sister company of Alcova Mortgage. I've been with Alcova for 15 years now. Myself and the three owners of Alcova, we're all from Covington originally, so we're all small town guys. Mm-hmm. And their story always made sense to me, and I loved them before I came here, to the Alcova side of things. Like I said, I was in the FDIC world, and to me, that was everything I'd always known. I came from a banking family, so it was like, that's what I'm going to do. And I never felt like I would end up in the TPO world, like Alcova was at that time. And when it came to be, it was the right timing and everything. I didn't want to be traveling all the time, like I was. But it went back to like the nuts and bolts foundation of that. And I've always enjoyed more of the nerdy side of the mortgage world, which once again is completely counterintuitive to what I'm doing now. But I've always been involved in the servicing portion, the compliance portion, the regulatory pieces. And I like to see how those work. And we sat down, it was right after COVID, and the owners were like, hey, we want to start something new. And truthfully, I was burnt out. We've all been there. No matter how successful you are, if you love what you do, you just reach this point where you're just kind of done. And, it was this post-COVID world where the rates were low and everything was booming, but I just found myself being very unfulfilled. And it was at the right time. They're like, we want to start a private equity lending side. And I was like, boom. I didn't even ask questions. I was like, let's do it. Just threw caution to the wind because it felt like the right decision. And that's how it came to be. And it's been great since.
That got you excited.
Yeah, it did.
I think that's the biggest thing.
Yeah, you find that, we all are passionate about things, but no matter how high the peak is of your passion, you're going to have these lulls. Mm-hmm. And if someone catches you at the right point, it can lead to a bad decision or it can lead to a very good decision. This was leading to a very good decision.
Yeah, it got that spark. And to your defense, it was not hard to get burnout during COVID.
Oh, no.
Whatever you're doing, as many mortgages and home sales. And I remember at one time, and I had kind of internalized it as being normal at that period because I'd only had my license maybe a couple years before that hit. But, I was getting texts all the way up till 11:30 p.m. at night.
Of course.
And we had to go see the house the next morning at 8 o'clock.
Well, and the refi boom that was going on then.
Sure, yeah.
My wife and I, we did the same thing. It was like, why would we not just go ahead and lower into the twos for the sake of doing it? Knock yourself out. Who cares? It's $5,000-$6,000 in closing costs. You're saving so much money. It was almost like, it's like everything else in this industry. It's feast or famine. Mm-hmm. There's not a lot of gray area over here. It's either awesome or you're just kind of channeling for business when it comes to the conventional mortgage world.
So you talked about being in the FDIC and then moving into TPO. Can you explain what those mean for the viewers?
So FDIC is your traditional banking world. I had kind of split time between normal banks and then credit unions. So I also have like a CUNA Mutual kind of background where, you learn those backgrounds of credit union rules versus banking rules. And then TPO is like third-party origination. So Alcova would serve as the person that originated the loan, get the whole package together, and then sell it to another investor. Where people are always like, oh man, they've already transferred my mortgage. Well, everybody was going to transfer your mortgage because it's the larger banks, going back to that FDIC field, that want that paper. But it was COVID that kind of changed the way Alcova was looking at things as well. When I was started with the servicing portion of Alcova, we held, like, no joke, 20 loans at a time. And they were mostly, what you would consider scratch and dent files, something that couldn't be just regularly sold to USDA or FHA or somewhere on the conventional side. And during COVID, we grew that book of business to over 11,000 files in the span of like 6 months. And those were all Alcova-owned pieces. We were handling the servicing portion, which was a huge undertaking.
Yeah.
But you had to adapt and learn, during that whole COVID process.
Nice. And then what's the TPO portion?
Third-party origination.
Okay, gotcha.
So you're the one starting the loan, get it all together, and then you sell it
And then you sell it off.
Mm-hmm.
Okay.
Absolutely.
Yeah, I think Alcova was... So we bought plenty of houses, and they all got sold within the first 6 months probably. Alcova was the longest. I think they held our loan for like 2.5 years.
Yeah.
I was like, oh, they like us.
Yeah, that was always the funniest. People are like, what, you guys not like, am I not doing the right thing? I'm like, no, you don't understand. It's just the shift in the industry.
Yeah.
There comes a point. You have to make assets move. Is it a prudent time to hold on to these things? It's great in theory when everything's super low, but if you're holding a bunch of 2.5% paper, 2.9% paper, how sustainable is that for the long term?
Get that off the books.
Exactly. It's time to move on.
Right.
So I'm really curious how the three of you decided to jump into the private lending.
Yep.
What did that look like, square one to where you are now? Because obviously you need money to do that. Mm-hmm. So what did that look like in the very beginning?
So we had an advantage, which was extremely healthy. So number one, the three owners of Alcova had all spent time in the flipping space, the short-term rental space, the long-term rental space, commercial. I mean, a lot of the stuff downtown is owned by the guys. And you have to find a lender for that. It's kind of like what Cody and I were talking about earlier. There's so many specialty niche markets. Like if you wake up tomorrow and decide you want to do a bunch of storage buildings, well, good luck to you. If you have a ton of cash, 3 years ago, people would have done those at normal banks. Now no one's touching those kind of things. But with us, we're like, okay, we're going to do this, and this space makes sense because it's quick rinse and repeat business. That's what I really like about it, is that it's every day is different. But most people, when they're starting this kind of company, you have to pool funds. So if the three of us sat down and we're going to start a hard money company, well, whether we go traditional fundraising routes or let's say somewhere out of nowhere, each of us has like an extra $333,000 sitting around and we can come up with $1 million. That's great. Now we're going to find one or two people who are going to flip houses. And then we're like, oh man, we're killing it here. We're getting those interest payments. We're like, we don't have any money to lend to anyone else until the payoffs come in. Well, let's say we lent our first 2 loans out to one of Cody's buddies and they're doing well, but then the market stalls. We're still sitting there hoping we're getting our interest payment, but this $1 million we have is gone quickly. So initially we were like, we're going to fundraise because the guys have done such an amazing job with Alcova of turning it from literally a grassroots idea in, apartments in Blacksburg to what it is today. A 24-year company that has huge, gigantic footprint all over the United States now. But we didn't know if that was the best route. So the way it actually started was we did use some Alcova funds at first. I think it was a couple $1 million, a very, modest amount to get this started. And we thought that would hold us over for 6 weeks. We were like, we'll see how it goes. We're going to get the money back, but let's just test the waters. What just happened that Bobby and I, with some other folks from Alcova, were going to a Commanders-Cowboys games. Lifelong Redskins fan here, so we go every year. And we were going with one of our warehouse banks. And that was the big positioning, as Bobby and I had discussed before. We were going to approach them based on our relationship with Alcova for so long and saying, hey, we'd really like a warehouse line. An FDIC bank behind us, which is so cavalier, and looking back was one of the most arrogant things for me to think that it was a good idea, but they trusted us.
Sure.
And it wasn't based on our idea. It was on the Alcova relationship. And that warehouse bank is still one of our biggest backers.
Nice.
So we have access to now, and starting from that point, the funds of all these bigger players in the industry. But it was based on the fact that people believed in us and our mission because they knew that we were only going to serve the communities in which we serve and doing it from a very ethical perspective. Because once again, you have 3 owners and myself at the time who all we knew was the conventional mortgage world. Mm-hmm. So not to circle around your question, it was really kind of we're going to have to figure this out. So we have to sit down and learn how other lenders are doing this. And we did. I spent that first year like going to conferences and everything and meeting all these giant players in the industry. And they're all, they all assumed that I was just going to broker deals to them. But I was just sitting there picking their brains. Every time there was a happy hour or a networking session, I was asking, how did you do this? Where did this come from? Why do you leverage to this point? Why does this not make sense for you? But in my head, it makes sense. And it was just getting that education. That's how we got to this point and developing the company.
Nice.
I love that.
Yeah.
Yeah. I mean, a lot of things to pull out of there, but I think the biggest one for me is, and I've always kind of taken this mindset, and I feel like it's definitely a superpower, but sometimes can be also a risk that I put on myself. But that whole figuring it out, as you do it, it's not like, let me get this all figured out and then we can go start it. It's, hey, let's take some initiative. Let's, put some capital up. We're confident enough in ourselves and our business acumen and just, the resources we're able to pull together, the people we're able to talk to.
Yeah.
And we're confident enough that we can figure this out as we, build the plane as it flies, essentially.
Absolutely.
Yeah.
I mean, if it's a 10-step process and you have 3 of the pieces figured out, the other 7 can either come to you by doing the first 3 properly or just falling on your butt. I mean, like, there's going to be some hiccups along the way. Sure. But if you're, a risk mitigator by nature, which we tend to be, it usually kind of shakes itself out. And not to say we didn't. I mean, we definitely had learning lessons along the way. But, it just kind of worked out for us to go through the process and learn it and just really listen to what people wanted in this side of the industry.
Absolutely. That can be transferred over to pretty much any business, but real estate investing as well. I mean, we talk to tons of people that are still figuring it out.
Yeah.
They never get their foot in the door and they never get started.
Yeah.
So you have to have that kind of confidence, arrogance, whatever you want to call it, to be able to, actually go out and make something happen that hasn't been done before.
Of course.
So you mentioned the fund. Was this like a traditional kind of like debt fund that you guys put together and raised money for?
Yeah, it was literally just fundraising. So you know how some companies become a REIT, a real estate investment trust, or a private fund. Then you have to assemble, and we had to use that through our attorneys, which that was the other thing, is by learning the lessons we did, is we started using the same attorneys that our bigger counterparts did. Because that's the other thing I love about this side of the space. It's not competition. Realistically, it's just who works for you and in your physical current space versus who doesn't.
Sure.
And with us, it was more of like, there was that portion of us that was like, oh, we can raise tons of money very quickly. We're still very beyond grateful for our warehouse banks behind us, because that is kind of a slow burn process. Sure. You have to have a few years under your belt to really start making fundraising work. With what you all are doing now, I've known you now for quite a few years.
Sure.
You wouldn't have done this 4 years ago.
Right. Correct.
You were good, and that's why we put faith in you in the beginning. But at the same time, we were like, now it's like, oh, this makes total sense.
Yeah.
You have to get that reputation behind you.
Show some proof.
Mm-hmm.
Yeah. Yep. And that's why we document as much as we possibly can. YouTube, our social media channels, the emails we send out, like, it's just a constant like information wave. This is what we're doing now. This is how this turned out, the good, the bad, and the ugly.
Right.
And it causes people to trust you more because, and you're not just surface level, like, hey, this is all rosy and,
it's all about shifting that mentality, right?
Yeah,
from the HGTV presentation to reality.
Right.
Because reality is much different. No one's going to the middle of Texas, like we all are very familiar with that one show, and flipping these single family ranches.
Right.
And you're like, and in your head, you're like, that's a $2.4 million flip. This isn't normal.
Yeah.
People don't do this.
Right.
Shiplap is not that easy. This is a giant project, and there's so many pieces that got the person to that point. And, that's our big thing, is the education piece.
Awesome.
The education piece. Explain that.
So us sitting down here right now, I'm guaranteeing you, even though I know Cody much better than you, I'm going to learn something new today. But it's because I listen. I know that I don't know everything. And there's something different about every single market and what you all see going on. For us, it's very easy to look at a deal on paper. It's great. But if you're not paying attention to the situation and either educating your borrower and having those uncomfortable or comfortable conversations, like, if it's you, for instance, and you're like, hey, I've got this house and right here in the middle of Roanoke, and I know this is going to be the value. But if I run AI or some desktop valuation, I'm like, Christy, you're off by like $30,000. Well, then it's up to me to still listen, because you can in reverse educate me and be like, no, I'm the one that ran the comps. I know this market. I know that this is in the Hollins area. So I see what you're saying, but that $30,000 you're talking about, look at the one 2 doors down that sold for this, or this is their coverage ratio for a DSCR loan. I know I can rent this for better. So it's just all about paying attention and educating our borrowers, and also listening to what they have to say about their local markets.
I love that. So CFS is not too big to be able to have those conversations.
Correct.
Yeah.
So
I think that's really valuable.
And that's where I think I hate to use this word, but I think that's where we have the upper hand. Mm-hmm. We believe in supporting only the markets in which Alcova serves. And there was logic to that. While every other company like us lends in every state except for Alaska, Vermont, North Dakota, and South Dakota, which is common sense. Those are very low price point markets or very weird states to actually record title in. We only lend where there is an Alcova presence. So let's say that you live in the middle of, I don't know, South Carolina, great example. And I'm going to do the flip because we've had this conversation. It makes sense to me. But then you start ghosting everyone. Let's say you're a few days late on your payment, and then I can't get you on the phone. You know, the team around me can't get in touch with you. You're not responding to emails. Well, the good thing is I can call up one of my Alcova loan officers that happens to be from that area, because most of our referrals come from that network, and say, hey, can you drive by this house and just pop a couple pictures? Let me know what's going on. It's amazing how quickly that works, and how much it makes it just more user-friendly by only serving the areas that, not that you care about, but the ones that you have a presence in. That
makes a lot of sense. Mm-hmm. It also makes it easier on your underwriting portion as well, because you have partners in those areas that know the market specifically. That's great.
And if you notice, people are loyal to the weirdest individuals. Like oh,
don't we know?
I mean, that is a definite double statement. I apologize for that one.
No, that's me too. I'm the weird one.
Like if you think about the people you trust the most, like my barber, ladies, your stylist, they know more about you than your own family knows. And it might be that you guys have been friends for 25 years, and that's cool, but it's someone like that. But the accountability level that people hold to their local mortgage person or their local realtor is astounding. But it's because those people spend their time developing a trustworthy relationship, a reciprocal relationship, where it's okay to have these conversations back and forth. And that's why we've done what we've done, is we trust the people that helped us get to where we are. Yeah. And that doesn't mean I don't spend my fair share of time knowing that there's areas that were huge ebbs and flows as far as trending goes. But if it's an area that I'm not quite keen on, but I have a flipper who's already done 30 properties with me in the last 2 years, I'm going to trust him to do it in this area because it's a low price point, and we know that he always has an exit strategy.
Right.
Yeah.
So someone who is coming to CFS for the first time, what is it that they would need to bring to you to prove to CFS that they are a good fit? Yeah.
So this whole side, from the lending perspective, it's going to be different for you all, but what we care about is cash, credit, and experience. So from a credit perspective, let's say we all have an LLC. As long as we're above 680 on our credit score, we're good there on the credit portion. The experience, we love to make sure that someone's done at least a couple of these, whether it be on their own cash or if they've used another private lender. And that's not to say that we haven't entertained first-timers from time to time, but those are more of the deep relationship first-timers, whether it be someone that we've worked with for 20 years. They're like, hey, I have the capital to do this. I've just never done it. We're going to do that. Or if it's, a realtor partner who is great and we know they're great, but they just haven't spent as much time doing their own portfolio as they have for others, we can make those kind of things around that. But 2 properties normally is what we want to look at for the first one. And then the cash. And this is where we get to talk about the leverage portion. This is my biggie. So whatever you show us on paper, checking, savings, money market, your investment accounts will calculate at 50%. We take that, multiply it by 7, and then we're willing to expose you to 80% of that. So let's say you're wanting to take on a $240,000 flip, but you have $100,000 you've saved. Well, simple math says you can't buy a $240,000 house for $100,000. But if you go with our methodology, you're instantly able to be exposed to $560,000 worth of lending, because $100K multiplied by 7, 80%. That means now we're taking your capital, which you've worked hard to get, and we're expanding your capital. We're taking your 5-year plan and turning it into a now plan. That's kind of the big thing. So those are the items we need to see. Driver's licenses for anyone on the entity, your entity documentation. and track record, contract, scope of work. That's about it. Yeah.
So what I'm hearing in that example that you just gave, the $100,000, multiply it by 7, 80%.
Correct.
Is that because if it were to fail, they can take that $100,000, feed it back into the deal?
Exactly.
And then
they have reserves that you can. Our big thing is we never want to be in asset management. A lot of people in our line of business want to foreclose. They want to take deed and lose. They want that kind of stuff. And I'm not knocking those types of companies, but if we're trying to build a relationship-based company, what looks better? If you all have 3 clients that we've done a great job for, we've helped them get this project to the finish line, whether they made $50,000 or they just barely broke even, that's still a win. Or do you want to see all the trustees notices in the newspaper or online of us taking over every house we finance? Yeah. We chose a different path.
Well, and from a business perspective, if you burn those guys and you didn't have to, what's the chance that they're going to come back and do more business?
Exactly.
Or even just get out of the game completely. So if you can help nurture some of those, maybe sticky situations, because it always happens. I mean, there's going to be flips that you do that you may lose a little capital on. You may break even. You might make a small profit, not hit what you were hoping to. Sure. But if you can stay alive, that's part of the game.
Yep.
And if you guys can help, be flexible and help them through that, they're going to be that much more likely to be repeat business for the company.
Exactly. And it also opens people up to figuring out how they want to diversify. If we give them that kind of exposure, there's a lot more value to be found in, Roanoke's a great example, the New River Valley, and, Southwest Virginia in general. Sometimes you can get a great deal on 3 houses compared to 1 on the same block that are held up, by multiple owners. But one house might actually cover all 3 of those based on the flip. And then let's say the other ones are complete teardowns. Cool. You have 2 buildable lots that you can either sell to a developer, or if you want to do a construction loan and do it yourself and sell a home, knock yourself out.
Sure.
It's all about scaling within reason.
So what are some of those products? Like we're talking about leverage. That was one of the things that drew me to you guys off the start, obviously the relationship, but this episode is brought to you by Southern Trace Builders. Whether you're dreaming about a custom addition, renovating an outdated space, or creating the perfect indoor-outdoor setup for your family, Southern Trace specializes in bringing those ideas to life with quality craftsmanship and a smooth building process. From kitchen and basement remodels to full home additions and outdoor living spaces, their team serves homeowners throughout the Roanoke Valley and Southwest Virginia. Check out their recent projects and learn more at southerntracellc.com. Just getting started, you do have limited capital. Some people don't even have the 100,000 that we're talking about. Maybe they've got 30, maybe they've got 50. But when you're using leverage and you're using some of the products that you guys have, you can take that $30,000-$50,000 and actually, do some big deals or really get into some properties that you wouldn't normally be able to. So how are your fix and flips short-term loans structured, and what do people have access to when they do that?
The big thing is just speed. Everything is 12 months or less. You want to be in and out, not just for our sake because it makes our books look better, but truthfully, and you guys educate everyone on this, holding costs is the name of the game.
Oh yeah.
I mean, you can have a spectacular deal, but if you've been riding out this entire 12 months, because we do have higher interest rates in the side of the business, you're doing yourself a disservice. And it doesn't matter if you're mad about the deal because of something you did or something I did. Either way, it leaves a sour taste in your mouth, and you're not going to want to proceed with this. So for us, it's that 12-month structure. The other goal is being aggressive enough on pricing, but being conservative. So back to the structure piece, I hope you don't mind me using you as an example.
No, for sure.
You do some rural flips. Those don't make sense to every other lender, because if you're based in Bridgeport, Connecticut, or Manhattan, or the middle of Dallas, you're not thinking about the fact that a house that is 2 hours outside of Roanoke, Virginia is going to be lucrative. But for us, we didn't want to tether back on that loan to value or that loan to after repair value for rural properties. So for us, we still try to look at, if you're a good borrower, and like we kind of mentioned earlier before we started recording, we like to cherry pick who we work with, because, we want you to be successful and for us to be successful. We're not going to look at a 60% loan to value. We're still going to look at those, truthfully, at those 80 to 90% coverage of the purchase price and 100% of the renovations, depending on your strategy, of course.
Sure.
That's where it gets a little weird. So it's kind of hard to have this structuring conversation, because what's your end game?
Right.
Are you going to turn this into a rental? Well, I'm not going to give you 100% leverage unless it's a smoking deal, because if you're going to do a long-term takeout on the backside, I have to qualify that first loan to make sure it matches that. So you're not dude, you gave me a great deal, but I have to pay $35,000 to get this into my rental portfolio. I'd be like, not my problem.
Yeah.
Well, we don't do that. That goes back to that conventional mortgage background. Our structure is based around the needs of the client versus what is the smart thing for us to do. And I think that's how our deals always kind of come together. And they're always going to be fix and flip or bridge financing. If you all find a great deal where there's one fix and flip, but then there's two other properties that are like, I might not do anything with these, I might wholesale them. That bridge might be the key for you,
Sure.
where you have to put minimal in, but you just happen to own now 3 properties side by side, and you can offload these as you're going through the fix and flip process, or if you're just going to wholesale all of them yourself.
Right. Awesome. And you mentioned there, rolling into permanent debt. So one of the things I'm super excited about that you guys are doing is, taking this short-term structure, but putting another incentive on the back of it and an exit into a BRRRR deal. Is it a DSCR loan that you guys have come out? Yeah. So how does that function together?
This is the first endeavor where we've truly kind of looked more of a partnership with the Alcova side of things, because no matter what, this is a very unregulated side of the world versus a very regulated side of the world. Mm-hmm. Now, obviously, it's much different on those DSCR loans because they are non-qualifying mortgages. They're in that weird space, but we're not going to do those on our own books because, once again, we want that short-term debt to churn and burn through. And we really didn't want to broker out to partners that we had just met through CFS because, once again, you have to go back to that original relationship and making sure that this works. But for us, let's say you come to us with a deal and you're like, I found this house. It's $40,000. It needs $60,000 worth of reno, but I know that this thing can rent for $1,400 a month going forward. Well, if we go ahead and qualify the DSCR, just run through our quick qualification and making sure that the ratios are proper, 1-to-2 or whatever they have to be, 1-to-1, we can go ahead and tell you this is the most we can do on this fix and flip, but you're not going to have to pay more money out of pocket other than what you should be expecting. Number one, you're going to have to get an appraisal on the backside. There are going to be closing costs. It's going to be a dual closing. But then we can help people achieve that wealth growth strategy. Because truthfully, don't get me wrong, I love fix and flips. It's what I live for every single day. But there's 2 channels of ways to think about this. It's either instant cash with a risk, or there's long-term strategy. And if you're making those properties perform for you, then you want them to pay themselves off in 5 years. That's why we don't care. I mean, not we, but you as a client, myself as a client, wouldn't care about that payment amount on those DSCRs as long as your rent covers it, because it's going to pay off in 5 years anyway.
Right.
So what do you care about prepayment penalties? Work through it, make the money back, get your yield spread based on what you're making on top of the payment, and then ultimately you either own a free and clear, rental property, or you can offload that and move on to the next thing, depending on what you want to do with your portfolio.
Yeah, that's been super exciting to me because, I like the fix and flip game. I like the fast cash part of it because it allows me to go out and do bigger and better deals, stuff that I want to hold long term. But I'm definitely in the phase of building as many assets as possible to also be able to leverage those into bigger deals down the road.
Exactly.
It's why the podcast is called Built, because we're building a portfolio, we're building an asset, we're building a business. And this is a great way to be able to kind of take that fix and flip strategy, but give you, it also lowers risk because it allows you to have 2 different types of exits. It's like, I could sell this if the market allows it and I need to, but I also have an opportunity to be able to just roll this into a DSCR loan and hold the asset and reap the benefits of, depreciation and cash flow and everything that comes with, having rental property.
Yeah, and I think it's even a bigger piece here. The 3 of us wouldn't be talking if this wasn't a totally capitalistic endeavor. I mean, we're not here for charity. It is to grow your personal wealth, but also educate folks around you. But truthfully, and I can't speak for you two, but I would think that it would be the same as me. You want to create viable inventory for your community. I don't care if it's rental. I don't care if it's for sale. You want people to, one, be able to reclaim properties. Nothing thrills me more than bringing life back to an old property. But giving folks either A, the chance at home ownership, because we're seeing a diminishing number of people under the age of 30 that even think about home ownership, or giving viable rental options. And so if we're doing that, it seems to me that, once again, it's not philanthropic here, but at least we're all doing the right thing from a conscience level as well.
For sure.
This episode of Built is brought to you by Creative Financing Solutions. If you're a real estate investor looking to scale your business, fund your next flip, or move quickly on an opportunity, CFS was built for you. Their team understands the challenges investors face because they're investors themselves. With flexible fix and flip loan programs, fast approvals, and a team that prioritizes relationships over transactions, they help investors get deals done. Visit cfsgo.com to learn more and check out our Built podcast with Chris Lemons.
Yeah, I mean, it's helpful. And just so the listeners out there that might not know what DSCR is, so that stands for debt service coverage ratio. And essentially what they do is they take the expenses of the property, what you're bringing in as revenue, and they look at that NOI number, and then they base what your DSCR coverage ratio is based on the debt amount, the debt service that you're going to be paying. So they'll look at your NOI and then they'll divide that by the debt service. And that's what we were talking about with the 1.2 ratio. Yeah. As long as that hits, 20% less than what you're bringing in income, then they're willing to give you the loan, and you kind of have a 20% buffer there in your debt expenses. So just so you know what DSCR stands for.
Right. There was another strategy that you mentioned as well a little earlier on, the bridge.
Yeah.
Can you help break that down for us and what that looks like in an actual deal?
Yeah. And, maybe you're not the flipper here. Maybe you're not the person that's going for that, long-term rental strategy. Maybe you're just wanting to acquire properties to sell. That's something we can help with as well. As long as it closes in a business name, you can just grab multiple properties. And I never encourage people to go out, auction hunting or tax auction hunting, but there are these crazy off-market deals you'll find where, let's say, mom and dad owned almost a city block for 60 years, and the kids just don't know what to do with it because they've moved on, they're living their lives elsewhere, and there's no strategy. It's just sitting there going stagnant. They might just want to go ahead and get out of it. So you would want that bridge loan to go ahead and grab those properties, and then you can either, if let's say it's a hoarding situation or the yards are just filthy, do a little prep work, get it cleaned up. You can turn around and sell those things. And even if you're making $5,000 to $10,000 on each one of those parcels, you're literally growing your personal wealth at that point that you can turn into viable projects for yourself. So the bridge is just is that bridge to get you from point A to point B and that holdover in the middle instead of tying up your capital.
And so is that more 100% LTV when you lend on those, or is it 90, or how do you typically look at that?
Yeah, it's very case by case. Okay. So in theory, I would love to have the 90% just because, it frees us up on some things. And let's say these are distressed properties, remember, because all three of us work in that space, non-bank financeable properties, which freaks a lot of people out. But for us, that's what we're looking for. We want the junk, because you can make it something great on the opposite side. I would love to stay in the 90%, but like I said, if you're getting a portfolio piece where all of a sudden the value is so good and you're getting it for 60% of what it's actually worth, even on a tax card, yeah, we can look at 100% on that fairly easily.
Nice. I'm sure it's nice to show that the investor has a little bit of skin in the game. Right?
Exactly.
They feel like they've got something at risk.
We can't take on the whole inherent risk there. I mean, now, but that's once again going back to that relationship piece. If it's someone we know, someone we've worked with in the past, there is, more of that. And I think that's the other huge differentiator in what we do is I'll never forget when we started the company. I was so sure of myself because I'd been to these conferences as well as guys, and they're like, hey, it's not personal. It's black and white. And talking to those people, I'm like, man, this is kind of a loan sharky side of things. Yeah. And I'll never forget, I sat down with the owners of Alcova, and Bobby was the one that specifically said, he's like, no, this is going to be the most personal hard money lender, private money lender, whatever you want to call it, anyone's ever seen. And I remember going, oh, God, this sucks. I don't want to do this. I want to go to the numbers game.
Right.
But as it turns out, that plan and methodology was awesome because it opens us up to those conversations. It cuts risk down. It means that I can be honest with someone and be like, listen, we're friends here, but this situation or what you're presenting, it's not good. And it's not good for us and it's not good for you. So let's do something different. Or we can, have those honest conversations of like, you're almost there. You're right there on the cusp, but it doesn't warrant an exception at this point because you don't have this. That honest and open relationship is what really kind of changed everything there.
Yeah, those, I always tell people, people kind of poo-poo on lenders a lot of times whenever they're trying to get a deal done and the lender's like pushing back on them or they won't give them the loan, but they're there just as much to like be your partner and keep you out of situations where you could get yourself in some hot water.
Yeah.
If every lender just said, yeah, here's the money, like people they'd be upside down all the time. Just
it'd be absurd.
You can make the numbers look however you want them to.
I mean, we can make that recession happen whenever we want to, but let's try to avoid that for a little bit.
Yeah, exactly.
It's for your own good too.
Right. Exactly.
Have you ever had a deal go bad that you were involved in? And what did that look like?
We have. And, we're very blessed. I would say lucky, but we've learned diligence along the way. And this goes back to what we were talking about earlier.
Mm-hmm.
We had to learn some lessons here. But in the thousands of loans we've done over the last 4.5 years, we've only had, I think, 13 go south. Some of them were very easily avoidable. Had we had a little more proper diligence on the front side and didn't over leverage folks that maybe shouldn't have had that kind of exposure on the front side. So we got a little bit more out of the trust thing to the trust but verify thing. It doesn't mean there's not room for that. Mm-hmm. Or folks that did what they should not have done. And I mean very illegal activities, unethical activities, whatever they are, because people, once they get that reno money in hand, it's amazing. There's a discipline involved.
Yeah.
But then if you have that little thing in the back of your mind where you're like, I think I'm going to take up meth. It's a lot easier to do when you have 40 grand in your pocket.
Expensive habit.
Right.
Yeah, it's an expensive habit.
You know, it's.
I mean, if you're selling it, that's one thing.
Exactly. I mean, if that's your wealth
multiply the money.
Yeah, exactly.
You can leverage that
and do both, but there definitely is a discipline.
But that's, how those things look. The key there is, number one, everything closes in a business name. So number one, the foreclosures do tend to be a little easier than your conventional home foreclosure. But it doesn't mean we're not left with messes on the backside. Out of those ones we've taken, less than a third have actually been completed projects that were good to go. We've had some that were completely not done, things of that nature. But then that's your exit strategy, finding out, do we just offload this to a local flipper? Do we finish this flip out? What do we do here? And luckily, because of our trusted network, we've definitely had some where, on those few that we've had to take back, that I'm able to call someone who is a good flipper that's only 20 minutes away. I'm like, hey, do you want a good deal on this house? Do you want to finish this one? And they're the first to be very honest and say, listen, no, I don't want it, and here's why. Mm-hmm. And that's just another feather in our cap of knowledge, paying attention and listening of, let's not do this area. Again, there's a reason for it. We've definitely learned our lessons there in a few markets, specifically Georgia. Georgia's a really tough one. If you have a lot of cash on hand, you're doing the deals yourself, Atlanta's a great area. But if you're not and you don't know the area, it's a nightmare.
Is that just resale timing or
resale,
pricing or
market saturation?
Okay.
There's a high proficiency for mortgage fraud for some reason in Georgia.
Really?
So there's a lot of just kind of moving pieces there that just really hurt what could otherwise be a very strong market.
Gotcha. Mm-hmm. Interesting. Wow, so you talked about different markets, and one of the things that resonated with me, because we're building Haven out, and we started in the New River Valley, and we've kind of moved some focus over into Roanoke because there's a lot of opportunity here. Having that boots on the ground for me, like when we're looking at markets to expand our investing in, I think it really lowers the risk for me if I know, hey, we've got a strong management, construction, sales team with boots on the ground in that area, so we can take down these deals and kind of be able to service it and go out and solve problems like that same day if we have them. But what are some markets that you've noticed seem like they might be on the come up, or markets that might have a lot of opportunity right now, and that's just maybe one or two catalysts that kind of push it to the next level? Do you see any of those with a lot of the deals that you're doing, especially since it's more regional and national now?
Yeah. Virginia-wise, Stanton and Waynesboro, surprising areas, fascinating areas, because, if you're not from that area, which none of us are, you don't quite know the amount of industry that's coming in from Harrisonburg down to that area and the housing that's needed. And we're talking about very high-paying jobs and professions. I think, because we're all from the South, all we know is a Buc-ee's is there. Well, now there's
Sweet Buc-ee's.
There's north of Grumman. There's the Hershey's factory there. There's a correctional facility. There's housing is desperately needed. So what we've seen, and it was a very big shock to me personally, was over the last 3 years, the number of deals I've done in the Stanton-Waynesboro area, and they're all very good deals.
Nice.
Getting great acquisition prices, very cosmetic in nature on the renovation, and they're selling very quickly. So if you're looking at a trending perspective, that portion of Virginia is lovely. If you're looking to get in the short-term rental game, if you're saying to yourself, I do want an Airbnb or a VRBO, this is the nuts one. The most lucrative Airbnb or short-term rental destination in Virginia is Page County, Virginia, which is Luray Caverns.
Really?
The most lucrative and the highest number of short-term rentals per capita of any place in the Commonwealth.
Interesting.
And it's an interesting trend, and I'm wondering if that bubble is going to shift because, we all have that joke where it's like Northern Virginia and Southern Virginia should be two different states.
Right.
Well, it turns out people in Luray still identify more with the southern portion of the state in the way they work and operate. But the Northern Virginia, DC, Metro, Baltimore area folks are the ones that started to swoop in and get those because it became more of like a playground and a nice area to be in that was a break from the city and stuff like that.
They're going and visiting the South.
Exactly. As much as you can. Yeah. And then what we've seen in the times that I've spent there, with some of our Alcova partners and some of the realtor partners I have there, is it's almost becoming very adversarial in its approach too, because the locals are like, baggers coming in, taking our land. But at the same time, they're really rejuvenating a very tired area because I know I'm in my 40s, but the only thing I ever knew about Page County is I remember taking a field trip to go to Luray Caverns.
Yeah.
But other than that, I don't really know much about the area. Right. In the Carolinas, Greensboro, Winston-Salem, and High Point, that's your hot areas. Nice. Charlotte obviously is one of those things that's always stable, but it's starting to price out a little bit. It's getting on that hefty side.
Winston-Salem's been on my list.
It's such a great area.
Yeah. And it's, it's got a university there. Mm-hmm. It's got some city infrastructure, but I'm constantly doing research and like trying to talk to people in other markets that, they've got some infrastructure, they've got population, they've got a good median income, but there's a housing, either shortage or, something that the private equity firms haven't moved in there and started gobbling up, swaths of single family houses or multifamily real estate and things like that. And Winston-Salem was one of my lists. The Tri-Cities area, like Bristol, Kingsport, Johnson City, like that's a super interesting piece.
Well, because for some reason, that area of Virginia and Tennessee, even if you're going down to like Johnson City, back to the Bristol, Virginia side, down to like Jonesboro, Tennessee, which is right in the pocket there beside Johnson City, they built a casino and it's really helped that area. Danville is kind of the opposite right now, which is fascinating to me because, we have a lot of great partners in the Danville area and they were all very excited when the casino was coming and they started acquiring properties and they would move very quickly. They were getting them. But now that the casino is there, it's almost like that market stalled again. Mm-hmm. And it stings, because I think that if you're from Virginia, the one thing you always want to see is somewhere like Danville or Martinsville making this huge come up again.
Right.
Because, whether it be your generation or your parents' generation, there was a time those economies were huge.
Yep.
Furniture making business, textiles, all of that jazz, just like Galax was at one point. It doesn't mean that, we can make all those areas come back, but I think that was kind of a surprise for everyone noticing that trend.
Yeah, Danville is actually one of my list. I just talked to a broker yesterday. He has got they're townhomes, but like a portfolio there that he sent me. And we've been looking at that market because, like you said, the casino came in. Pricing there is still pretty low. Mm-hmm. I think we were looking at them at like between 60 and 70 a unit, which is fairly low, for anywhere in Virginia. But they've got the casino that came in. They just announced like a major data center that's breaking ground. Tyson's Foods there. Like there's like 3 or 4 other pretty major companies that are bringing 500 to 1,000 jobs.
Of course.
That have already broke ground. It's not just like a concept. Mm-hmm. So I'm interested in that market, but you're right. It's kind of stalled at the moment. I mean, I think their 1-bedrooms were renting for like still in like the 600 to 700 range. 2-bedroom townhomes were like 850 to 900.
Right.
And like, if you look around anywhere, you're like, where can you find that?
No.
Which is like an opportunity, but it's also like, there's some risk there because you don't know, even though those companies are bringing all these jobs, it's like a 5-year plan, so it's like, can you get in now or do you wait until you start to see the trickle up? But then at that point, the prices start to adjust. And
that's, I think you bring up a really interesting point there. It's when you're looking at these markets and things of that nature, the hype has to be there from the beginning and people have to go all in on it. I think that people were very trepidatious when it came to just the casino coming because, there is still that stigma around that area that it's just very stalled. The community had fallen in a bit of disrepair, a beautiful city, but it had its struggles.
Right.
It takes more than one industry. So that's where, I would have that conversation with someone and wonder, what's that takeout strategy look like? Are you able to pull money out of other projects to pay this thing off and understand that you may be holding these for 3 to 5 years without turning a huge profit?
Right.
That's where you have to figure out what works the best for people.
Yeah. I've been reading a lot of books on kind of some of the titans of Wall Street, and Sam Zell has been the guy that I've researched the most here recently, and his nickname was the Grave Dancer.
Right.
And that was his thing. He would like find up and coming markets that haven't necessarily hit their peak yet, but had, a demand catalyst or some sort of supply and demand shortage.
Yeah.
And he would swoop in, during either economic downturns or just before anybody else got in the market, he'd place some big bets. And then for him, luckily they paid off time and time again. And he ended up coming like the world's biggest office, broker. He started a REIT a REIT for multifamily that he had picked up around the nation. Super impressive. But it kind of spoke to me because a lot of the properties that we take are pretty much at their grave. Like we're coming in and picking them up and trying to rejuvenate it. And we've started to kind of look into markets. I think Roanoke's poised for that too. I mean, there's a lot of industry coming into Roanoke here recently.
It'd be great. I'm from here and I love this area, but to be completely candid and honest, I think the one big pitfall that I personally have seen, and this may get me in trouble for saying, is that there's just not a lot of good flippers in this area. And I don't mean that being a good person. I mean more of really kind of shooting for the moon and not paying attention to what the market really needs at that moment. Sure. Folks that are like, oh, it's Southwest County, I'm going to pick this up at $329 and I bet I can sell it for $549. In theory, you can.
Sure. But
talk to the other person that has a house for $519 that's been sitting for 4 months on the market that's already done. It's more of that shoot for the moon mentality or not paying attention to what your market actually needs. And, it kind of ties back into the conversation we were just having. So like another market that I'm very jacked on and something that I've been seeing a lot of work improving in is like Columbus, Ohio and Cleveland, Ohio.
Okay.
If you want that dream market, and I mean, if you have crews there that can help you with this, it's a dream market. I mean, you're talking things between $25,000 and $45,000 that might need $55,000 in reno that can turn around and sell in the $140,000 to $150,000 range. It's a huge rental market, and you can build a rental portfolio in that area very easily. Not easily, but very sustainably, very effectively.
Nice.
And those are the kind of markets I get super excited about. It just makes more sense.
There was a lot of guys. I was at a multifamily conference this weekend, and people invest all over the place. It seemed like the folks that got into Dallas, Austin, like Miami, they rode that wave up, but it's starting to come crashing down. Like oversaturated with new inventory. Rents have gone down like 12 to 20%. Year over year the last couple of years. But there were a lot of guys that were in Ohio and doing deals in Ohio and stuff like that. So it kind of piqued my interest to some degree.
I have a very, very good flipper that I work with here in the area, and I won't mention names or anything, but he has a very strong Ohio presence as well. And he loves it, does a great job with it. And his is just a flip strategy there. He's not holding any for rental. But then when you get into the Metro Cleveland area and outside of that, that's where you're looking for that development of, long-term rentals.
Sure.
It's huge. It's clutch for that kind of market. And, around the Columbus area, that's where you can also think to yourself, okay, is a strategy for me, do I want to be near a college? Well, Ohio State's right there in the middle, right off of High Street. That's where it's at. If you can pick up a duplex there, you're talking about a much different strategy for that wealth growth. When parents know that their kids are going to be there and they're going to sign a 12-month lease paying $3,000 for a room per month, it's very interesting to see how these markets shake out.
Definitely. Yeah, it's always exciting looking at new markets. It's, I always have to kind of pull myself back and be like, what's the realistic, expectation of this too? Because getting into places you haven't been before, there's unknowns. But, again, goes back to, do you feel confident you can figure it out? Have you underwritten it, with those contingencies and assumptions and stuff like that?
And you would know you're an award winner.
Yeah, right. That was so unexpected, man.
That's right. Yeah, that's really cool.
Well, two things. So like on my way down there, I was on the plane and I, connected to the Wi-Fi and I get this email and they're like, hey, Rod would like to have you. And it's Rod Khalif's, mastermind program. He's got, I think, the biggest commercial real estate podcast on iTunes and Spotify. And I was on my way down there. And 2 years ago when I went into that conference, I felt like the smallest fish in a big pond. It was like, I don't even know if I should be at this conference, like just trying to soak it all in, ask a lot of questions, learn from people, and get this email from his assistant. She's like, hey, Rod would like to have you on a panel. And I was like, what do you want me to talk about? But it was interesting because, there's people I was on stage with have 1,000, 2,000, 3,000 units. But I think the perspective I was able to give, there was a lot of beginners and people that haven't even gotten into the space, that were sitting in the crowd. And for me to be able to tell my story between, hey, I was sitting exactly where you were 2 years ago, and now we've gone from, 30 units to 250 units, in a matter of that time frame, I think it kind of helps put some perspective. It's like you're not just sitting here watching, people that have 2,000 units and 20 years of experience. Like you can do this and get a lot further than you think.
Right.
And then the second day, I was actually getting ready to leave. Two things happened at that conference. One was, I was on the way down there, and I was on the plane, got my Wi-Fi, set up, and I get this email from Rod's assistant, which, is the Rod Khalif Multifamily Conference, and he's one of the biggest kind of coaches in multifamily in the game. And she reached out to me and was like, "Hey, Rod would like to have you on one of his panels at the conference." And I was kind of like, "Well, shoot, I don't know what you want me to talk about." I was like,
right.
I'm still a small fish in this pond, I feel like, but I think it was good for the listeners because there was a lot of beginners out there, or people trying to get into their first deal, or maybe they've gotten one under their belt and we're looking to scale. But to sit on the same stage as people that had, 2,000, 3,000 units, have been doing it for 20 years, for them to see like, hey, 2 years ago when I walked into this room, I had maybe 30 units, and now I'm sitting at 250, and like through the experiences from the group and learning and just picking people's brain, like you can get a lot further than what you think you can get.
Oh, of course.
Just by putting your head down. And then the award that I actually got was called the Massive Freaking Action Award. So, again, it went back to like, I don't have the most units in the room. I'm not the most experienced here, but through my socials, through the podcast, through, posting in their group about deals that we're doing and looking for partners and capital and stuff like that, he was able to see like, you've taken the goals that you set when you joined this group, and you've gone, so much further than you even thought that was possible in the last 2 years. And I think that also kind of spoke to a lot of the people there. It's like, if you put your mind to it and you kind of capitalize and execute every single day, like good things will come out of it. There will be rough times, obviously, but there's always going to be that on the climb up.
Yeah.
So.
Well, and that relatability factor, I think, and that's why I love this podcast so much and what we're doing, because I'm still a beginner. You're still a beginner.
Yep.
And so starting here, I think, is good because, we're not at the scale where people don't think it's achievable.
Right.
So, yeah, I would agree with that.
And I love that.
Mm-hmm. Yeah. And there's this constant, like, at least I feel it personally, where it's like, I achieved something that I didn't think was possible, and then you can get comfortable at that area. But like, do you stay comfortable at that area, or do you make yourself uncomfortable again to level up to the next level? And it's like this constant, like, okay, I learned how to do this. Now I'm here. Let me set my sights on this next phase. And it doesn't always have to be something different, but maybe it's a different scale of where you're at right now, but you want to constantly growing.
Yeah. As long as you're identifying your buy box, that, that's the biggest piece of advice that you can always give anyone. It's kind of like when you're looking for your dream home, what you can buy here, what you're looking at, it's always fascinating to me that people, when they're buying their house, are like, my budget's $400,000, and they're willing to go 425-ish, maybe something in the 390 range. They're going to find something. But when they get into this investment side of the world, they're like, what I want to do is I want to buy $100,000 houses that need 50 in reno. They can sell for 210. And then before you know it, they're like, I found one. It's 289. Well, you've got to be disciplined.
Right.
Diligence is key for not just us, but for anyone that's doing this. And then, yes, you can scale up appropriately if you're able to keep yourself tethered.
Yeah. I mean, there's levels to it.
Exactly.
You got to learn what you don't know and then add to it. So kind of wrapping up, Chris has a lot of good products. We've used pretty much all of them at this point. Obviously the fix and flip loans. You guys will come out with the fix to rent, which I'm super excited about. We're definitely going to take advantage of that. Some of the bridge options, which Christy and I are actually underwriting a portfolio right now that we might need to talk to you with.
I think we're going to have to talk about
after
it.
the deal.
We can knock that out.
I think it could work because it's got multifamily in it. It's got single family that could be sold off. So I think that'd be a heck of a conversation to see how.
And that's kind of like what we want to look for. We want to help folks grow in the aspect that they want to. And then if it's a little bit out of our comfort zone, if it makes sense for you and it's logical for us, we're going to do that kind of situation, because it's a win-win for everyone.
Yeah. And then, we mentioned multifamily, even some of the smaller multifamilies we've done, Chris helped us with a 6-unit, pretty much full gut fix and flip in Radford, or not fix and flip, sorry, fix to rent. And, it was kind of a little bit outside the normal box, but
for us, it was way outside of the box, let me just tell you.
Like, we could not there's no way a traditional bank was going to touch that thing, because it was boarded up windows, it was graffiti, and, wieners drawn all over the place.
Oh, no.
I remember that.
Yeah, there were just
it's coming back to me
all
now.
sorts of nefarious stuff. There was like animal feces in the building, but we were able to take basically a bridge loan,
Yeah.
Do the full construction process. I think we bought it at 300,000 and put about 350 into it with the help of CFS. And then once we got it stabilized, now the traditional bank's willing to come on the back end and take that loan out. And we've been holding it for 5 years now. It's performing wonderfully. So,
what was the ARV on that?
1.25.
Yeah.
Okay.
So
it's in such a desirable.
We've got 650 in it, and it's the ARV, appraisal we got was 1.25, and it's cash flow, and it's like, I'm not selling this thing.
That's incredible.
And that's at a 7.75% interest rate.
Yeah.
We were looking at it yesterday, me and my partner, and I was like, hey, if the rates move down within the next year, like even if we have to take a penalty, it might make sense to try and refi this thing and get that into the sixes at least.
I think we'll get there.
Yeah.
I mean, we're desperately overdue for something in that capacity, but once, like we were talking about earlier, it's just defining the tipping point.
Yeah.
And that's obviously above our pay grades.
Right. Yeah. And just by the way, with those different strategies, we have a free school group. It's called the Haven Investor Network right now, but we're about to rebrand it to the Built Investor Network. And we teach a lot of these strategies, fix and flip, house hacking, the BRRRR method, value add multifamily. So join that group if you haven't. It's a great place to, look at deals. If you've got questions, like bounce them off people that have done it. There's Chris's in there. There's lenders in there that can help you out if you've got questions and you're just trying to get started. So that link is in our bio. But as we wrap up, what's the best way for people to find you and reach out to you, Chris?
Sure. There's two ways. The easiest way would be go to our website, cfsgo.com. Of course, if you want to go ahead and apply now. You can also email deals, DEALS, at cfsgo.com, and our team will get with you immediately. My big thing, once again, back to the relationship piece, is once you reach out, let's set up time to have lunch, discuss this, because we want to get to know you and build the relationship more than just numbers.
Absolutely.
Yeah.
And if you're in that school group, he's got a pinned post in there. So you can either reach out to me to put you in touch, or his information will be in there as well. So we appreciate you coming, man. This was a great one.
Awesome. Thanks for having me. Yeah, this was
Absolutely.
great.
So
I love
value.
talking real estate investment strategies and building businesses. I mean, that's essentially what you guys are doing too.
And that's what you guys are doing as well.
Right.
That's what everyone here is doing. So you guys are doing a great job. So keep on rolling.
Yeah, we'll have you back.
Yeah, great.
Awesome.
Thanks.
Thanks.